Internal controls over financial reporting, ICFR, are a set of processes, policies, and procedures that an organization puts in place to ensure the accuracy, reliability, and integrity of its financial statements and reports. These controls are designed to prevent or detect errors, irregularities, or fraud in financial reporting, ultimately aiming to provide assurance to stakeholders, including investors, creditors, and regulators, that the financial information presented by the organization is trustworthy. Publicly traded companies are subject to an external audit by an independent auditor to ensure that the company's financial statements are presented fairly. But it is not feasible for the audit firm to audit every single financial transaction, and auditors might rely on the company's governance and management to implement and administer effective internal controls over financial reporting to demonstrate that the company is fully committed to an environment of integrity and ethics. Under PCAOB AS 2201, the external auditor must form an opinion on the internal controls over financial reporting and either prepare a separate report on such matters or include the assessment in the auditor's report. The auditor may be held legally liable for deficiencies in the audit of ICFR, much like the deficiencies in applying generally accepted auditing standards and material misstatements in the financial statements. As part of that requirement, auditors evaluate whether management's philosophy and operating style promote internal controls over financial reporting, management has sound integrity and ethical values, particularly of top management, and the board and audit committee understands and monitors financial reporting internal controls. The auditors then issue an audit report that states their findings, such as the one for Apple, where Ernst & Young stated, "We have audited Apple Incorporated's internal control over financial reporting as of September 24, 2022, based on criteria established in internal control integrated framework issued by the Committee of Sponsoring Organizations of the Treadway Commission, 2013 framework, the COSO criteria. In our opinion, Apple Incorporated maintained, in all material respects, effective internal control over financial reporting as of September 24, 2022, based on the COSO criteria." The process is not perfect, though, and audit deficiencies related to non-compliance with AS 2201 continue to be the most frequently identified deficiencies. The most frequent ICFR deficiencies identified related to insufficient testing of the design and operating effectiveness of selected controls, particularly with a review element. Specifically, some auditors did not evaluate the nature or the appropriateness of the procedures performed by management during the review, including the criteria used to identify matters for investigation and the actions taken in investigating and resolving such matters. The principles of the COSO framework are: 1. Control environment. 2. Risk assessment. 3. Control activities. 4. Information and communication, and 5. Monitoring activities. Let's look at each of these principles in more detail. First up is the control environment. The COSO framework states that the organization demonstrates a commitment to integrity and ethical values. The board of directors demonstrates independence from management and exercises oversight of the development and performance of internal control. Management establishes, with board oversight, structures, reporting lines, and appropriate authorities and responsibilities in the pursuit of objectives. The organization demonstrates a commitment to attract, develop, and retain competent individuals in alignment with objectives. The organization holds individuals accountable for their internal control responsibilities in the pursuit of objectives. The control environment essentially is the tone at the top and the organization's foundation of ethics. It includes that the company promote a culture of honesty and integrity, including a code of conduct and code of ethics, as well as creating a positive workplace environment, implementing a whistleblower policy, implementing best practice hiring techniques, ethics and other mandatory training, and discipline around expecting all employees to comply with policies and procedures. It would also include ensuring that accounting software and other financial software can only be accessed by authorized personnel, establishing separate user profiles and roles, having unique passwords, and rotating duties, and requiring mandatory vacation time. Even in the best of organizations, there are risks that theft and fraud could occur. That is why organizations complete a risk assessment as part of the second principle of the COSO framework. As part of the risk assessment, the company identifies risks, estimates the significance of the risk, assesses likelihood of the risk occurring, and determines the appropriate mitigation of the risk through internal controls. Control activities are internal control activities over financial reporting that mitigate the risks that were identified as part of the risk assessment. First, we have segregation of duties, basically that no one person is responsible for end-to-end processes that would allow the person to perpetrate and conceal fraud. For instance, the person who invoices customers should not be responsible for collection and posting of cash payments. Next is the proper authorization of transactions and activities, for instance, that granting of credit takes place before a customer shipment takes place, and that only authorized individuals can purchase on behalf of the company or sign checks. The third item on our list is adequate documents and records, which means that the company includes pre-numbered documents prepared at the time of transaction, timely depositing of customer payments, and that all sales are supported by authorized shipping documents and approved customer orders. Physical control over assets and records includes that a password is required before entry into the computerized accounts receivable master file can be made. Only authorized individuals can authorize bank transactions, and only authorized individuals can purchase assets. Last on our list is independent checks on performance, which includes activities that, for instance, the accounts receivable master file is independently verified. Information and communication. The COSO framework states that, as part of this principle, the organization obtains or generates and uses relevant, quality information to support the functioning of internal control. The company internally communicates information, including objectives and responsibilities for internal control, necessary to support the functioning of internal control, and communicates with external parties regarding matters affecting the functioning of internal control. To summarize, this principle is all about the timely and complete delivery of the control activities. Control activities are only valuable if they are completed. Information must be communicated in a timely way for employees to carry out their responsibilities, and reports must contain relevant operational, financial, and compliance information. Monitoring means that the organization selects, develops, and performs ongoing and/or separate evaluations to ascertain whether the components of internal control are present and functioning. The organization evaluates and communicates internal control deficiencies in a timely manner to those parties responsible for taking corrective action, including senior management and the board of directors, as appropriate. Essentially, this principle assesses the quality of the internal control system, makes modifications as necessary, and represents ongoing processes through normal operations. In summary, an internal control framework provides a structured approach to managing controls throughout an organization, while ICFR is a subset of these controls specifically focused on financial reporting. Both concepts are vital for maintaining financial integrity, reducing risks, and ensuring compliance with regulations and standards. They play a crucial role in building trust with stakeholders and protecting an organization's financial reputation.